Today we're going to be covering off chart preparation. I'm joined by Idris.
Yes, I've been trading for circa 5.5 years. Chart patterns, technical analysis mixed with fundamentals is generally what we trade. Big fan of support and resistance, key levels, etc., which is what we are going to cover today.
Fantastic, good. Now, and obviously we've begun to work together just on the basis of both having a very similar alignment in our vision. Obviously, making sure that we're looking after protecting capital, sufficient risk management, and also making sure that we can apply this to a very good strategy to make sure that we are being as profitable as possible when we're all trading. So I'm going to let Idris take over now and run you through some of the key support and resistance zones and a few more tips that you're going to need to make sure that you're dressing up the charts in the right way.
Yeah, spot on. Thanks, Ben. So basically we're going to cover how to mark up naked charts. A lot of people struggle with trying to identify and trade an environment. So hopefully off the back of this masterclass, you'll all be able to understand how to kind of break down a chart, mark on the zones, the key zones that you're looking to trade from, and have a bit more confidence and a bit more of a methodical approach to trading, right? So we're going to go through monthly key levels, weekly key levels. We're going to check these. There's two different ways you can check these. So we'll mark them on one way and use the other kind of method to check that they're accurate. And then top-down analysis. So we're going to dig in from our higher time frame and dip into our lower time frames. And then we're going to identify our daily H4 support and resistance. They're kind of zones that you kind of manipulate between whatever time frame you're actively trading from. But again, we'll dig into that and give examples, and then obviously any chart pattern. So we've got the zones marked on, we've got our key levels marked on, we know where we're looking to trade from, and then we're just looking for different chart patterns, breakouts, etc., to actually execute these trades, right? So got a little bit of text here. Trading becomes much more simplified when you have a basis to trade from. By having zones marked and knowing where to expect a potential price reaction is very important for knowing where to enter, place your stop loss, and also where to place your take profit. So during the management of an open position, you also need to be aware of where to expect price resistance or support, or general price zones of concern, which might stop your trade moving into deeper profit. It's going to move this over. And then having your zone set up is the first thing. Understanding risk management and having an entry-exit strategy is the next. So all of which you can learn through live market experience, but can certainly be fast-tracked with a mentor or valuable course tools. So we'll dig into some live charts now. If I quickly flip to US dollar, Canadian dollar. So this is the example that we're going to use. I'm going to first go through monthly key levels, right? So the way we tend to do this, you don't have to go too far back, but you'll definitely notice these when you're digging into kind of more localized charts. So your hourly, when they pop up, you know the significance of the support and resistance, right? So we generally use a traffic light system. So red for monthly, and then we'll use amber for weekly. And then we'll use, generally don't do daily, but daily would be green. We mark the dailies on the actual time frame, so we can actually see the boxes, the zones, rather than these hatched lines, right? So we just find that works better because we generally trade the daily chart, and we also trade the 4 hour quite a lot. So obviously if we have these massive zones for the monthly, if we have these massive zones for the weekly and the daily, you're not going to be able to see anything on your chart. So it's going to be too clustered. We obviously want to make things as easy and clear as possible. So effectively, what we're doing, we're marking on our monthly key levels now. We're on the monthly chart. We're looking at US dollar, Canadian dollar, and any key pivotal points. So where price moves quite aggressively, so it's pushed up and then reverse instantly, right? So here, for example, not valid. Here, for example, yeah, probably more so valid, or something more so valid would be an example like this. But we're going to take a methodical approach now, and we're going to start at the current price and then work backwards, right? So literally just copy and pasting these lines. There's a good one there. Like I say, this is the first method, and then the second method, I will show you exactly how to do that. So you don't obviously want to go, you don't want to kind of close your charts up like this, because you're going to see things back to kind of 1994. So just work locally. It's really important. Work locally, because you don't want 1,000 of these. You just want recent price, right? So you can see here, this cluster that we've got takes us back to 2015. That is absolutely plenty. What we can do, we can just blow this up a little bit so we've got a bit more accuracy. And then we've got we've got another one here. So you can see key pivotal points. It's pushed up and then it's reversed quite significantly, right? Some of these might actually not be valid, but like I say, we'll soon find out. What I'll do, I'll go through all the monthly, and then we'll check them, and then we'll go into the weekly. You'll find sometimes as well, the weekly may kind of coincide with the monthly as well, which is just, see it as an additional confluence, right? it might seem like there's a lot on here and there's loads of stuff, but obviously when you blow into current price, on the 4 hour, on the daily, we'll probably be looking in the region between maybe 134 and 135 handle. So whilst we can see here, we can see up 142 all the way down to 121. When we dig into the lower time frames, we'll definitely be able to see kind of much less of these. It'll be less kind of busy.
Also, Idris, how I know a lot of people are curious about different indicators to use and you know, dressing up the chart in different ways, and I think some people have become victim of overdressing their charts a little bit. What's your thoughts on kind of the perfect amount and how far back you should go, how many indicators you should use?
So I generally don't really use indicators. Sometimes I might use an RSI. Again, I just find they're quite lagged and delayed. Trading indicators, I mean, I know there's different tools and EAs and stuff that people use which are effective. I know you've got obviously a product which is good. It's been tested. Statistics are there and everything, which is all good. But in terms of actual trading indicators, I don't really tend to use them. I just find they're a little bit delayed. Sometimes with EMAs, SMAs and stuff, I'll use them for trend trading, but we don't really trade too many trends. It's more chart patterns, break and retest, support and resistance and stuff. So we don't really tend to use them in all honesty. I know a lot of people do, but again, sometimes less is more. Or in the majority of cases, I find less is more. And obviously, by clustering your charts with all these indicators, I think sometimes something might seem right and then something might seem wrong, and then it's like, oh Christ, you don't know where you sit. So I always say to people, try and find reasons not to take a trade rather than to take a trade. And if you've got tens of indicators on your chart, one of them's not going to work, so you're never ever going to take a trade. So price action, key level, support and resistance, that's my Bible. We've got most of the monthly key levels marked on now. So before we flick to it, what we're looking for is a monthly bullish close and then a monthly bearish open and then a big bearish candle. So the candle body should tie up. So let's flick to it. So here, for example, bullish open, bearish close, bearish open, and then we come back down. So you can see how that bullish candle is in line with the close of the open of the next one. So it's not like it's gone up and closed above. So here, for example, it's exactly the same. Here, for example, it's exactly the same. We've got quite a few clusters around here, so I can't actually remember which one's tied up, but we're slightly out on this one. So, or it might be, we're slightly out on this one. So let me just leave that exactly where it was actually, and we'll flick back to see what was going on. So I've actually marked that on slightly wrong. So let's go back.
Be fairly precise.
Yeah, you got to be precise because you think, obviously we're working from a monthly time frame at the moment, aren't we? So if you're out a little bit, you might be out 30, 40 pips on the lower time frame. So, but for the most part, I mean, that one was tied up there. I'm just going to leave that one there because I mean, I know we drew that one on that point, but again, there, we've got another one there, another one here, another one here, another one here, another one here. So you can see they're big reversal points. It's where the month has opened and the month has opened again for the next month, but then there's been a massive reversal, right? So key pivotal points. We'll quickly dig into the weekly, do it a few weekly ones, and we'll see exactly where we are. So what we'll do now, we'll literally just place another one and change the color because it's quite important to be able to identify these. You want to identify them because it's the same as price action. It's the same as like top-down analysis. The higher time frame will always kind of outperform the lower time frame. So you think when you're trading like, I don't know, 5-minute candlesticks, like that doesn't have as much significance as a 4-hour candlestick. So let's say you had for example, you see engulfing candles on the 5-minute every 20 minutes, don't you? There's always something going on, but that candle doesn't have the same impact as it would for the 4-hour because the 4-hour has got so much more data kind of collated into that candle that it's more true to a kind of a fair reflection on what's actually happened. Does that make sense? Like there's loads of 5 minutes are very noisy, right? 5 minutes are very noisy, and the higher time frame, it's got it kind of distinguishes, kind of puts out all that noise. So anything that might happen, it's got so much time to kind of unbalance that or balance it. So
yeah, I always find that the higher time frames is just easier for you to identify the general trend. Yeah, and then when you go to execute and look at the slightly more, should we say, macro aspects.
Yeah, definitely.
Then the lower time frames are where you're at.
Yeah. So here, for example, there's almost that's almost on top of each other. So we've just marked that on and drag that one up. But again, like I say, it's just like an additional confluence, isn't it? So
yeah, that's nice when you see them both line up.
Yeah.
That's when you know you're on a fairly strong trend there.
Yeah, exactly. So we'll mark on a few more. I'm not too sure about that one, but we'll chuck it on anyway. Another one there, which is good. Another one there. But yeah, like I say, so obviously if you're actively trading and you see a monthly key level, you know that's going to be, there's more chance that's going to hold over the weekly. Basically, that's where I was trying to get. It's the same as like price action confirmation on 4 hour. It's going to be more true than a 30-minute confirmation candle. Do you know what I mean? So
Yes. Yeah.
let's call that a wrap on that one. So
Yeah.
this one's slightly out. So the monthly obviously has slightly more. It's going to be slightly more accurate because there's less candles. But here, for example, a little bit out there, not to worry. There's one good one there. Probably should have stuck one there, shouldn't I? Yeah. There you go. And then what else do we have? One there, slightly out. Well, that's probably for this cluster here. But you can see here on the weekly generally isn't as punchy as the monthly. The monthly is like very kind of choppy, isn't it? Very kind of more reversals. It's just because there's more in less, if that makes sense. So there's the monthly done. There's the weekly done. We've had a little test. Let's see where we currently are. So obviously current price, we're looking for anything around here, aren't we? Like I said, we were at 144 here. We're down to 124. We want to trade active price. So let's dip into the daily and what do we see? So now we're looking to do our top-down analysis around current price. Straight away, what you can see here, you've got our kind of support resistance zone. So without even marking on daily support and resistance, monthly key levels have already effectively done that for us. So you can see here, support, resistance, then we go down to support, and then we push up again, a little bit of a fake out, come back down again, support, back up to resistance, back down to support, and then we see a break. We also, so it would have been quite interested if we saw something around this area here. That would have been quite good because we've obviously got the 2 daily closes. We're now approaching that again. I'm not going to dig back into it and have a look, but generally what we're doing now is trying to identify what we can trade from. So let's see, we're approaching a double bottom. We've had a support and resistance break. We're probably going to dig into this more so than a daily trend. Let's see if we can mark on a trend line though. So again, like we always draw wick to wick. Wick to wick, we just find works better for us. Obviously, don't fix it unless it's broken. Wick to wick for drawing trend lines. Obviously, you can't always draw them perfectly. So sometimes you might have to take like maybe a line of best fit. But I mean, for the most part here, so we're slightly falling a bit short here on these candle wicks, but we're a little bit over here. But we've captured the kind of average in between. So we'll be happy with that. Whether that kind of influences what our support and resistance range is doing, I don't know, but we are now going to dig into the lower time frame. So now we can see active price. We're blowing up our active price, right? So this is our kind of localized trading region. We've got 1, 2, 3, 4, 5, 6, 7, which might come into play, and we'll just kind of see what happens. So what we're going to do now is mark on our support and resistance. So resistance, we're going to class that possibly class that as a fake out. So we'll mark on our resistance. So what we generally do with our resistance zones, we'll mark on, so the average cluster, so the average time price wicks into the resistance, we'll capture that. So we'll capture the top of the zone, the top of the box will take the top candle bodies. So we said we're classing this as a fake out, right? So what we can also do, I'll mark this green so you know it's resistance. Oh, internet connection's just gone unstable. That's worrying. So we'll mark that on as resistance. The zone, again, it's just more a zone to try and capture the mean of the attempts going into that zone. So we might want to pull it down ever so slightly here. So this is quite a big zone, circa 42 pips. Yeah, so that's quite big. They generally tend to be about between maybe 20 and 30. But again, it depends on the pair. Faster moving pairs might have bigger zones. For example, GBP Aussie, GBP New Zealand dollar, US dollar, Canadian dollar is a relatively slow pair. So we've got our resistance marked on. We'll mark on our support now, which is going to be this region here. So again, let's just blow that up a little bit more. You can see here, we've just captured, so it ties up with two instances there. So we've got those candle body closes. So the bottom of our zone captures that and also captures that almost, but we've got another attempt here, another couple of attempts there. And yeah, that's a relatively accurate zone to mark. So quite happy with that. I'm going to close it up a little bit. Probably going to pull that down ever so slightly as well, just to make it a little bit smaller, a bit more accurate. also now we've dug into that, we can see that we were just above a bit long on that one. So we've obviously got our zones marked on, resistance and support, I'll call it that. What else we want to consider is our fake out zones. So fake out zones, so we've captured the bodies, and we're going to capture the wicks now, and that's going to be our fake out zone. So for example, what we're doing now, you can see we've just highlighted to the end of that wick. So let's say, for example, we had a bit of an engulfing candle here, and we took a trade, right? So we put our long position in, we had the engulfing candle from support. So from support here, mark that red just to identify support and resistance. Normally mark this some sort of color that doesn't really influence anything, maybe white. That's our bottom fake out zone, right? And what we're doing, so let's blow this up again. If we're looking to take a trade from this, the only thing to be concerned is, and the monthly key levels, the only thing to be concerned with is what is stopping you from getting a big burst very quickly to make your position risk-free. So obviously what we're doing, we're looking to trade in between the support and resistance range here, right? We're looking to trade buy from support, sell from resistance, get your price action confirmation, justify your risk reward potential, and then go from there. So this is our confirmation candle. It's very small, but let's just hypothetically, we've had the bullish candle from support, then we engulf it. So that's our 4-hour price action confirmation. Remember, we're on the 4-hour chart now. We've drawn our support and resistance zone on. What we're looking to do, we know our fake out zone is this white box, because that's where we've wicked down previously, right? So we're capturing that wick there. We don't tend to draw these fake out zones on here because we just drag and drop the stop loss kind of projection just below. So you can see straight away, if we didn't have that box there, put your cursor in line with that bottom zone here, and you can see it captures that, it covers that, right? But for the purpose of this video, we'll stick it in just in case. So you can see we've had the price action confirmation. We put our stops just below the wick zone, the fake out zone. The only consideration here is we've got a couple of monthly and a monthly and weekly key level very close to where we are. So that is a bit of a concern, because that means, okay, in this instance, you've got a monthly key level, which isn't even one-to-one risk to reward. So yeah, it's a bit of a concern. However, 1, 2, this will be the third. You've got your price action confirmation. Ultimately, you'll be looking to probably take profit in the mean range of this zone, because you don't want to be too conservative and put it too low, but you want to be, it's just the mean. You don't want to be too aggressive and put it at the top where the candle body's closed, but you don't want to be too conservative and put it at the bottom. You might do, it depends on your trading kind of style, how aggressive you are, your risk appetite and stuff. But generally, it's always quite safe to put it in the middle of the region, isn't it? So basically here, we've got a 1 to 6.7. So really, really kind of lucrative trade setup, which would justify taking that kind of gamble, having that kind of region of resistance so close to where you're looking to enter. So yeah, happy days. We'd take that 1 to 6.2, and then we just scale out accordingly. So when you get to maybe 1 to 2, take partial profits. When you get 1 to 1, move your stop loss to entry price, mitigate all the risk. 1 to 2, take partial profits. 1 to 3, trial your stop. 1 to 4, or wherever we are, take a bit more profit, and then trial your stops again, and then happy days, you've effectively scaled out of that position. And then when you get to resistance, you simply be looking to do the same thing. It's a support and resistance range. And you can see the resistance here. We fall just short of the weekly, and then obviously the monthly is just above. In this instance, we wick into both zones, but we close below the resistance. So there's a bit of a confluence here. Maybe not the best example, but you can see how instantly anyway, the way we marked on our support and resistance, the monthly and weekly key levels were both on the support and resistance anyway. So effectively, you didn't really need those zones. So from resistance, obviously we'd class this as a fake out. I'm not entirely sure what that was without kind of back testing the data. Probably some sort of economic event or risk event or something of the sort, because we've seen such a harsh sell-off here, right? And then we've also got a very kind of bullish spike here. So that could have been kind of economic driven as well. So, I mean, we're covering this wick here. If we were looking to sell from resistance, the risk reward straight away, you can see it's not as lucrative as the selling opportunity, because you'd need a massive stop loss, trading it down to support 1 to 2.5. So it's, in this instance, it's definitely better to buy from support rather than to sell from resistance. But if you can quantify something, if you've got a really good rejection or a nice wick, you could maybe consider putting your stop loss just above the big wick rejection, and it might enhance the risk reward. So again, it's all to your discretion, your trading plan, and what have you. But generally, that's how we tend to mark up our charts. This is just one example. We'll go through now. We'll go through another kind of a live example. We've already got marked up, right? So again, it looks like another support and resistance range. A lot of the markets at the moment, so like Ben said, it's the 23rd of the 7th, July. 2020, there's been a lot of sideways markets, So chart patterns, like we said at the start of the video, mark on your key levels, monthly, weekly, mark on your daily and 4-hour support and resistance zones. If you trade supply and demand as well, you can do that. Just mark them on with something different. So maybe a cyan box or something of the sort. But again, you're just using chart patterns, trends, counter trend lines and bits and pieces, channels, and then you can use the break, use the retest and trade that as well. So here, for example, monthly key level wicked into that region, kind of almost found support in that region. What else do we have? So big support zone in play here. We've also got, you can see previously we wicked down on that weekly key level, then pulled back and then we broke. And then we're kind of consolidating around that zone. So this is quite an aggressive moving pair. Obviously for the sell, we were looking for the retest of this broken support zone. So it is support, the red box here, it is support. We're looking for a retest, so it's going to be acting as resistance. So it's effectively an SR zone now. It's used as both. Previously, it was just support, but as it's been broken, it's now a support resistance zone. So we're looking for a retest of this region, a monthly key level, stops just above, and then we can trade it, look to set new lows. Obviously, first we need to break the low. So we need to break that low. It's still a 1 to 4 trade. If we break it, we can look to take profit at the next weekly key level, which would then be a 1 to 6.3. So, I mean, in this region, all you're looking to do is mark on your any chart patterns you see here. For example, it did look like a bit of a flag, and then GBP Aussie caught bid at the start of the week this week, and then we pushed up to resistance, and then we started to sell off. Massive bid for the Aussie, and then we just kind of blasted through that support zone. But I mean, generally, probably not the cleanest, because what I really would like to do is mark on some chart patterns and stuff. We're looking at the 4-hour at the moment. Let's probably dig into a lower time frame, but here you can see we've just got a nice bearish trend line to break out the trend. Nice trending environment. We haven't seen that recently, but for the most part, can't really dig out many at the moment. Let's try and skip through. Maybe Euro Aussie might show us something different. Pennants are good ones. Not too many key levels on here actually. Maybe I need to freshen these up, but pennants, for example, you might want to, let's go through a hypothetical example, right? So we do have some up here actually. So let's say, and we'll wrap this video up after this, but let's say we had a big flagpole going in, and then we had a pennant consolidation. And this is how you can use monthly key levels to help identify maybe where to place a stop loss. So typically with a pennant, you can see here we're consolidating, see how good my art skills are. How's that? And then we see a bit of a breakout, a bit of a retest, and that's when we're looking to enter. Typically, that's your standard entry. Everyone knows it. It's best practice. What you'd be looking to do is grab a long entry here, maybe a bit higher after the retest because you want some sort of confirmation maybe. So you sacrifice a bit of a better entry, and then you have your stop losses, right? So let's say we had a monthly key level, let's say it was here, right? So depending on what your take profit extension was, again, typically with a flagpole, you'd have that as your take profit extension. So going in there, am I going to grab the right thing? Yes, I am. And you'd have it maybe here. So that would be your extension. And let's say here we had another monthly key level here and another monthly, which is used monthly key levels, is not too important. Another one here, right? So at the start of the video, we said about kind of barriers and identifying where to possibly consider taking profit or partial profits. So this is what this can do. Previously on US dollar, Canadian dollar, GBP Aussie, we were looking at support and resistance, right? So we didn't get a chance to go through chart patterns, but we'll use a hypothetical example here. Like I say, we've got the breakout, we've got the retest, we have a bit of price action confirmation, and then we know we're looking to jump in this buy, and it's broken out. Happy days. We notice there's a monthly key level just below, so we know that because price is above, this monthly key level is acting as support. So let's use that to our advantage. We know price might reject that. If it does fall a bit lower, we might find support again. It might be due to recent price, or it might be due to kind of previous, kind of past price, but regardless, it's acting as support in case price pulls back down to this region. So we have the break, like I say, we have the retest, price starts pushing up, and then it starts pulling down, and we've tactically placed our stop loss just below in case that kind of falls, and that's our kind of last protocol. It's our last form of support. It's an additional form of support. Happy days. We may as well, if we can justify the risk reward. So we can, because we know we've got a big flagpole. We know if we're going to extend, we're looking at a 1 to 4 here. But the other things to note is we've got a monthly key level above, and we've got another monthly key level above. So what concerns does this raise? So obviously, well, let's say it's down here actually. So this is where we found resistance on the initial flagpole. And then we started to pull back, consolidate, and then we're looking to break above, right? So what we need to do, as always, we need to set new highs to maintain an uptrend. So for this position to be realized, we need to make sure that we break this high, because that's our kind of previous high. We need to maintain an upside break to maintain an upside trend. So we know we've got here, so 1-to-1. So is it worth it? The take profit extension is 1-to-4. So we might find resistance at 1-to-1, but yeah, why not? We can move our stop loss to entry price at 1-to-1, mitigate all the risk. If we break it, happy days, we're risk free, move our stop loss or move our take profit up. That's our next form of resistance. And we'll be looking at shouldn't have done that, should I? Needed to keep that there. We'd be looking now at a 1-to-2.86. So almost 1-to-3, just shy of. Even if you can bank a 1-to-2 out of this and scale out of your position, happy days. You know, the ultimate extension is going to be around 1-to-4. So this is just using key levels as an example, as potential obstacles. You've also got supply and demand. So you might have a historic supply zone here because price has just sold off super, super aggressively. Previous supply zone. So you might also want to consider that. Another area of resistance that's going to stop your position from reaching potential take profit. So all different things that you need to consider, but obviously we can't do it on everything. These come and go. They don't always form around the same price. So you might only see key levels as resistance. You might only see supply and demand as resistance, or local hourly resistance or local hourly support. But it's just important to be aware of these zones. And if you've always got them marked on, you don't need to do anything. That's the whole point in like price action and naked charts. Mark them on, go through on the weekend, add your watch list, do all your monthly key levels and stuff. So you can see here for the most part, not Western Texas, but Euro GBP, I've got some marked on. We've also got GBP, Japanese yen, got some marked on here. You can see weekly key levels, bang on support here. What else we have? We've got a bit of a break and retest on the weekly key level there. Again, ties up quite nicely there. Where else do we have? So you can see we generally mark them on most of our charts, and they have got some sort of significance. So again, monthly, very, very good one there. Resistance, 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 break, retest, and bang. Yeah, we've marked this zone on, but it doesn't need to be there. It's just because we were locally using that to trade. So it's nice to identify that zone. Obviously, for our members and stuff, it's easier for them to see and identify. Again, we have a big rally, and then we have a cluster of consolidation around the region of that monthly key level. So this is what I mean. As you approach that monthly key level, we've got a bit of consolidation. We could have sold off massively. So we might need to trial our stops into profit, or move our, consider taking a bit more profit, or whatever it may be. That depends on you. It's the way you manage your risk, etc. But there's loads of different kind of points for consideration. You can just see as we've approached that monthly key level, we've rejected, and then we sold off massively. So that's the whole idea. It helps you identify local support and resistance. It helps you identify potential reversal points. It's a very, very effective tool to use, and it's not really hard. It's quite easy. So it's really, really worth doing. It doesn't clutter your charts up too much. So yeah, I'd definitely advise it. Yeah. Is that okay, Ben?
Yeah, very much so. And I would agree. I mean, one thing that I guess is quite interesting is, I mean, how for somebody when they begin to do this for the first time, are they going to differentiate? I know from the beginning you weren't using candles. Now I know a lot of people do use candles. Yeah. But you know, how is it that you kind of identify, right, this is going to be the right area? Just as a quick, you know, overview,
quick summary.
First step. You want to make sure you're looking at, you know, on the line chart as opposed to candles.
Yeah, that's right. So obviously we'll zoom out. We're on the monthly, and then we'll scale in. Like I say, we are working from a very, very high time frame now, aren't we? So we don't want to go back too much. 2015, I mean, 5 years, absolutely plenty. And you really want to just identify these key pivotal points, right? So here, for example, it's not. So if we dig into the candles now, mind you, it is, but we've got a massive tail, which obviously that's no help, because that massive tail means, okay, yeah, it has closed here, but there's a massive fake out zone effectively. So,
yeah, we want that definitive.
Yeah, exactly. So you'll notice most of the time, not there, but most of the time, that they're relatively tight, but it's mostly to do with the line chart and where they kind of pivot quite abruptly.
Perfect.
Here, for example, that's a prime example. Kind of wicks aren't too bad, but it's where they close and then open, and then big time reversals. You close, open, big time reversal, close, open, big time reversal, big bullish. There's a couple of big wicks on there, but again, we open, we close, we open, and then there's a reversal, and where you can see there straight away 4 bearish monthly candles. So
very nice. And then it's onto the smaller time frames to kind of then obviously optimize.
That's right.
Not just the trend, but also then you begin to look at some of the entry.
Yeah. So obviously we didn't dig into much lower timeframes than the 4 hour today, but I mean, like I say, you do the monthly and weekly ones, and then you can mark on your localized analysis. So again, that's why we mark the actual boxes now, because this is what we're looking to trade from. We want zones rather than set price. So you need to give yourself, obviously, the markets, you need to give them a bit of a breathing space, because obviously if you're working from a set price, so the monthly key level here, for example, is marked at 172. We've got a weekly marked at 144. But we know that looking at price here, we've fallen short here. So we're deeper than those monthly key levels and weekly key levels, deeper here as well, deeper here. So looking at current price, that's why you use the boxes and the zones to take a mean of what's happening, because it's then a zone. So it can fluctuate anywhere in between that zone. That's where you're looking to get your reversals. That's where you're looking to get your entries. Obviously, what you can do is, I think I've done a video on this for my members actually. What can we do? We can use this, right? So to grab entries, what we could do is here, for example, big bullish, and then we wick into the resistance region, and then we've got an engulfing candle, right? So wick into resistance, then we've got an engulfing candle. What can we do now? So let's just say we've got a trend line break and retest. We're working from the 4 hour chart. We're going to dig into the hourly chart, see what happens. Oh, I can't remember where we were now. I think it was possibly this one. No. There's always a pain when you flick between charts. You can't always see. I think it was
I've lost it as well, if I'm honest.
I think it was probably this region here, right? So let's say, just remember this, 13th of July, 10 o'clock, right? We'll dig in again, 30 minutes. So this is obviously how you dig into the lower time frames and really try and grab an entry, because you'll just be using something simple like trend line break and retests. So you've obviously as a trend breaks, you're looking for a retest and then a continuation. And that's how you identify that there's going to be a reversal. So I'm getting lost now. Might be worth me just putting a link to the video. But I mean, we had the big rally. So
13th of July, 10 o'clock.
So we use this one. So simply put here, like we're approaching the resistance, right? We get a bit of an engulfing candle from resistance. So we wick into resistance, and we wick it again, and then we engulf. So this is where we're looking for reversals. And then we sell off, and then we pull back. There's our trend line break and retest effectively. So let's get rid of this because that was the big daily one. We don't need that. We're looking for, let's blow this up a bit more. So we're pulling up, pull back, pulling up, pull back, pulling up, pull back. Oh, sorry, pushing up, pull back. And then we see a trend line break, right? We're looking for a retest. So typically break, retest, and then continuation. We have the retest, big wick rejection. We don't set new highs, which is a significant thing to note. We break the trend line, retest, wick, and then we pull back, and then we have another price action candle on the hourly chart, which is good. So this is like an hourly structure. Retest, engulfing candle. Was that an engulfing candle or tweezers? Marginally engulfing. So we've got the engulfing candle. So there's two ways to trade it. You can be aggressive or you can be conservative. You can trade it short from the retest candle. So when that closes, we're still within. We've shown a wick rejection. We could probably forget all of this stuff now. If you want to really kind of increase your risk to reward, you can forget those zones because we're using an hourly support or an hourly stop loss now. It's an hourly structure. We've got our stop loss just above that wick. So it's also just above the rejection candle. So let's say we'll put it there. We've got a little bit of breathing space. We've got 25 pip stop loss. And we know effectively or ultimately we're looking to take profit around the medium support, right? Or the mean support. So what does that spit out? That spits out a 1 to 4, which is very, very good. We notice obviously it only pushes as far as 1 to 2.8. However, if you were looking to be a bit more conservative, wait for the price action confirmation, you'd wait for that next candle to show the rejection. So you've got the break, you've got the retest, and then you need the continuation. That is effectively your continuation candle. That's your price action candle. And then you need to place stops a little bit more above. So you'd be looking at a 42 pip stop loss as opposed to 25 or 26 or whatever it was. And obviously down to support, you'd be looking at a 1 to 2. But effectively, we only pushed as far as 1 to 1.3. So swings and roundabouts, depends how aggressive you are. Depends on your trading strategy, your trading style, whether you're conservative or you're impulsive. So this would be the impulse entry, and this would be the conservative confirmation entry. But again, sometimes the candles aren't as big as that, so it might still be worthwhile waiting for that confirmation because they might be smaller, and that still means you've then got possibly, I don't know, 1 to 1.84 or 1 to 2.6 then. So again, it's down to your experience. It's down to you to make that assessment whether you think it's worthwhile. And you can only make that assessment by kind of trading live charts and documenting your trades and stuff. So obviously there's various tools and stuff that can help with that. But again, you need that element of experience just to kind of make that decision. Does that kind of answer your question?
Yeah. Yes. Yeah. No, it does. It does. Yeah. There's that process that you have to go through every single time that you approach when you approach the markets.
Yeah.
And going through the correct setup, having that time and time again. You have your process set in place.
Yeah.
You put your risk and money management rules in place.
Yeah.
And like you said, providing you're doing that, then you should be onto a good thing. So
absolutely. I mean, there's various obviously. So sometimes you don't need to dig into the hourly. Sometimes you can if you want to just really optimize entries. But I mean, if you trade purely from 4-hour price, you could probably look to just do stops just above there, and then you could trade down to there. So again, you're only looking at 1 to 1.92, but you've just traded after the 4-hour engulfing candle. Not the best example, but there's other ones maybe. Maybe the buy from support. I think we've done that straight away, didn't we?
Yeah, there are really some really good examples in there from the past.
Yeah, I mean, here for example, that would be a good one. So we did say support was the better one to buy from. Yeah. Just looking at those fake outs before, but like there for example, you probably wouldn't even need to wait for a break and retest on the lower time frame. You could just be like, okay, we've got a bit of a price has been approaching very aggressively, and then it slowed down. Tried to attempt a bullish break upside, haven't. Pulled down again, then we've seen the bullish close, which is good. At the bottom of the support, it means you can have very tight stops. You wouldn't even need to dig into the lower time frame there because it's very clean, very clear. And then you obviously look to take profit in the mean region of the resistance, which obviously falls short. And then we push on the first attempt up to 1.1 to 1 or 5.68. So it really depends on. It depends on how clean it is. It depends on your eye for the chart and various other factors. But again, it's to the trader's discretion, isn't it? So hopefully that was of some use.
Yeah, very much so. So thank you for that. And I think that's something that a lot of people will be implementing, here onwards, and keeping the charts very clean. Yeah.
I mean, like I say, you don't need that box on there. You don't need that box on there. So all you can see is, and this gives you more than enough information to trade from. And this is why our kind of motto is trader made simple. Because there's no trades, no indicators on here. We've just got a few lines, a few boxes, put your risk reward projections on, maybe dig into the lower time frame for some trend line break and retests. And it's as simple as that. So sideways markets, it's not always the best, but if you can trade a good range, then why not? Mm-hmm. Don't fix it unless it's broken. So here you'd always look to buy from support, sell from resistance until it breaks. And there's your break. There's your failed retest because we want to kind of pull up to that region, but then we sell off again. So great, good stuff. Thank you very much,
Idris. Yeah, no, it's been a pleasure, and we'll look forward to hearing more from you.
Spot on, nice one. Cheers, mate.